Well, on a day where we got a fresh read of China's services sector showing the slowest pace of growth since January, and anything almost related to China is under pressure. We've got copper down. We've got casino stocks that have exposure to China under pressure. Oil's outperformance is remarkable. It's up about 2% right now, definitively above $70 per barrel. This, of course, on the back of moves that have been taken earlier in the week by Saudi Arabia as well as Russia to reduce supply in one way or another in order to put a floor under crude. We're looking at crude now up 3%. Let's bring in Rob Yawger, who is energy futures strategist at Mizuho Americas. Bob, this is the tension, right? You've got a slowing global economy, and then you've got this outfit that is doing whatever they can to try and support prices.
They're trying their best. I mean, they've taken a lot of barrels off the market. Now, one thing about the pricing today, that is a two-day print for WTI, for U.S. crude oil. If you look at the Brent contract, that's the one-day print. That's the change from yesterday. So that's up a little bit. WTI is up a lot more because we have the extra day to factor in the Saudi 500,000 barrel, the Saudi million barrel cut with the associated Russian 500,000 barrel cut that will take place in August.
That's important context, but as you mentioned, Brent is still up. So the bias seems to be, at least let's not freak out and sell everything because of this weak economic data. What does that tell you about the future path here? Is it just going to be kind of a holding pattern?
Yes, I think you're probably going to have a market that will be stuck in a range from $65 to probably approach $80 at some point in WTI. That's the U.S. barrel. That's going to be about, maybe $5 higher in Brent, $5 to $10 higher in Brent. So we'll chop around in those numbers. Demand is miserable. It's just not there. Everybody had bet the shop that Chinese demand would rip higher post-COVID. It's just not happening. Even the IEA, who I really respect, they usually do a very good job of forecasting the market, the International Energy Agency. They were looking for a big increase in Chinese demand in the second half of the year, but it's not happening. It's just not materializing. It's certainly not coming out as strong. So that's a big negative for the market. On the other hand, as you mentioned, we have the OPEC folks have effectively taken a significant amount of barrels off the market. The thing there is, though, every time they take the barrels off the market, we get a pop. Every time they take the barrels off the market, the pop is less than the one that came before it. So you're getting a pattern of basically a wave pattern of lower highs and lower lows. And that ultimately becomes problematic. Now, ultimately, you also will have the Biden bid in the market where they'll start to fill up the SPR. That will put a bit of a bid in the market. And it is important to always keep in mind that those Russian barrels are out there floating around. They're basically giving them away. And Chinese and Indians are scooping them up for size. And that also keeps the market from getting away. One
other factor that often comes into play is U.S. driving season. And some, I think including yourself, have talked about it's been lackluster. And I wonder if that's not for a lack of activity, but electric vehicles. And just maybe this is not ever going to be the catalyst that it once was as the proliferation of electric vehicles grow. How do you think about that?
There's no doubt. It's not going away, that's for sure. That is a number that's going to get higher every day the rest of our lives. It's banging up against 10% right now for the U.S. fleet on the number of vehicles on the road. It's going to continue to creep higher and higher. It's not going away. Now, that said and done, it's going to happen here a lot faster than it's going to happen in, let's say, India, which ultimately will be the global growth engine for energy. So there's going to be some bumps along the way as a percentage of global vehicles. However, here in the States, probably in China, and definitely in the Eurozone, every day it's going to continue to close the gap. Now, in India, on the other hand, they're starting from a lower base. They will go fossil fuel for considerably longer before they start to transition to the EV space. And that will save the day for the refiner to a certain degree. keeping in mind the largest refinery in the world is in India.